Welcome to the Value Investing Fundamentals course. In this course, I'll teach you how to get started in value investing fast. You'll learn exactly what you'll need to do when evaluating a company and what you'll need to look for when picking a stock to invest in. So if you're just starting out, or you're looking to learn value investing fast so you can start growing your retirement funds or portfolio more quickly, this is the course for you. Here's exactly what you'll learn in this course. In this course, we'll provide you with a strong value investing foundation. I'll teach you 3 easy, simple steps that you can follow to find and invest profitably in value stocks. You'll learn exactly how to assess a company by looking at 3 different types of value. This is critical because most investors only look at 1 or hopefully 2 when evaluating a company that they want to invest in. And that's why they end up buying a cheap stock at a much higher price. You'll also learn how to use a margin of safety to significantly reduce risks on your investments and correct all the mistakes you might make in your valuation process. I'll also teach you 7 golden value investing principles that every stock investor should live by. And in the last module, we'll also talk about 5 different things you can follow to identify if a company has a sustainable competitive advantage, so it can compete with other companies within the same industry. And we'll also make a complete value investing roadmap for you so you know exactly what you need to do now and what you'll need to do next. You'll know exactly your next steps and what you'll need to learn to become a successful value investor. So, if you're looking for a crash course on value investing and how to get into the exciting world of value investing in a profitable manner, I'd like to invite you to join us. Hey guys, welcome to Module 1. In this module, I'll help you understand quickly how the value investing strategy works in the real world. We'll dive into what exactly value investing is, how it works, and I'll show you 3 simple steps to implement this strategy so that you can profit from the stock market and grow your money. Okay, now let's get started. So what exactly is value investing? Value investing is simply an investment strategy where stocks are selected that trade for less than their intrinsic value. So what does that mean? Intrinsic value here is a real or true value of a company. By doing value investing, you simply invest in stocks that are currently undervalued or become temporarily cheap. Value investing is driven by the idea that there are ways to benefit financially from the events that cause stock market prices to swing up and down. So when there are rumors or bad news about a company, its stock price will drop. And as a value investor, you simply take advantage of these events and buy the company's stock at a much lower price. On one level, a stock's value is reflected in its current market price. Since the market price indicates how much investors are willing to pay for a stock at any given time, it indicates the stock's market value. But the key point to note in value investing is that a stock's market value is not the same thing as its fundamental or intrinsic value. Sometimes businesses can become temporarily popular or unpopular for a variety of reasons that have little to do with the true worth of their revenues, net assets, or their future income potential. So, as a value investor, our job is to find a company's true value and compare it with the current market price, so we can determine if the stock is worth buying or not. When a company's stock is undervalued, it means that it's selling at a price well below the value of its current and predicted cash flows. For example, a stock is selling at $3.21 a share, and you find that it's actually worth $5.67 a share. So this simply means this stock is undervalued, and it's a good buying opportunity because you know that the stock price will likely go up in the near future. So you simply buy low at $3.21 a share, and then sell high at $5.67 a share, for example. In this case, you can make around $2.50 a share in profit. At the same time, a stock that's overvalued is one that's selling at an inflated price, well beyond its true value or its predicted cash flows. For example, you find a stock that's selling at $5.67 a share, and after applying some valuation techniques, you know that this stock is only worth $3.21 a share. So this means it's overvalued or expensive to buy. There are chances that its price will drop in the near future, so we simply sell it or avoid buying it. You see, value investing can tell you exactly whether or not a stock is a worthwhile investment. With this information, you can easily profit from the stock market. So what is the smartest strategy for buying and selling stocks? As a value investor, we'll buy on bad news and sell on good news. Do you know why? Well, most investors will do the opposite. They buy on good news and sell on bad news. That's risky because they can easily buy an overvalued stock which likely drops in value. For playing safe with the stock market, why don't we wait until there are some rumors or bad news? These events will likely cause the stock price to drop temporarily, and the stock can easily become undervalued. And then we can buy low and sell high for making an easy profit. And similarly, we'll sell on good news because chances are the stock price will surge temporarily during these events and sometimes become overvalued. We simply sell at a high price and take the profit. So here's a quick tip. If an undervalued company is financially strong, with a solid profit history and promising future earnings, its market price is very likely to rebound after a temporary downswing caused by investor fear or disfavor. This means solid companies with efficient operations and strong financial performance are always winners. We don't care when their stock price drops because of bad news or rumors. Their financial performance proves that they can survive market downturns, and their market values will likely go back up and reach closer to their intrinsic values. So, to be a profitable value investor, all you need to do is find companies with a strong fundamental performance. In the next lecture, I'll teach you how to implement the value investing strategy. In this video, we'll talk about 3 easy, simple steps that you can follow to invest in a value stock. The best value investing strategy starts with learning to identify fundamentally strong companies. If you attempt to profit by buying stocks that have simply dropped in price without first ensuring that they have the underlying ability to eventually recover, there's a good chance you'll experience some financial loss instead. An effective value investing formula dictates that we must first look for strong businesses, buy when their stock is undervalued, and sell when it rebounds or becomes overvalued. Now, let's dive into each step so you can understand clearly what to do and how you can profit by investing in undervalued stocks. Value companies are not named for their positive market values, since every company's stock price fluctuates on a regular basis in conjunction with individual news events or occurrences within the market as a whole. A fundamentally strong business is known as a value company because it possesses actual inherent worth in terms of its consistent earnings, dividends, and cash flows. So, you want to make sure you'll only invest in companies with a consistent growth in earnings, dividends, and cash flows. These companies usually have a sustainable competitive advantage over their rivals that keeps them in the game, regardless of what their stock price may be doing from day to day. And it's this competitive edge that gives businesses a protective economic moat. Economic moat is something that helps a business remain financially competitive over the long term. We'll go into more detail about economic moats in the next modules. Even if negative events can cause a fundamentally strong company's stock price to dip, and here's an important thing, if that company can maintain its ability to continue operations as usual, it will rebound in time to a market price that is more in keeping with its true value. I want you to note that investors tend to have emotionally short memories. They won't remember what happened with the company in the past, and they only care about the present and the future. So as long as a company continues to demonstrate a consistently growing net income and cash flow, it's very likely to not only eventually regain its former glory after a price drop, but to become overvalued someday because investors start to recognize all over again what a great value it represents. And when looking for fundamentally strong businesses, some additional factors you should keep in mind are low debt and the presence of a strong and responsive management team. Overall, if a company has a history of performing well, you can predict that it will continue to do so over the long term. Once you've identified businesses that are fundamentally strong and that have a high intrinsic value, your next step is to add them to your watch list so you can buy them if and when they become undervalued. Under normal circumstances, stocks that are financially strong and that demonstrate promising future prospects are maybe too expensive to buy. For this reason, a fundamentally strong business doesn't always represent a good investment, because its stock value will have little potential to increase if you buy it when it's already trading at a price that's more or less in line with the company's intrinsic value. So in short, you need to learn how to find undervalued stocks, so you don't end up buying them at the wrong time. But there's good news. A strong company can easily become temporarily undervalued for a number of reasons. These can include one-time events, such as internal scandals or negative news reports that cause disillusionment, but make sure that these events don't cause the company to lose its competitive edge or its ability to go about its business as usual. If you wait for such occurrences as a company failing to meet its projected earnings, a downturn in the economy, a significant change in a company's business environment, or similar types of bad news, you'll find many great opportunities to buy a great stock at a very low price. These events will likely cause a stock price to drop, and when this happens, chances are it will become undervalued or cheaper to buy. And as a value investor, you simply buy low and then sell high to make a profit. Now that you understand the best time to buy into a financially strong company is when its stock has become undervalued, you also need to know when to sell that stock in order to make a profit. Although we know that a high-quality company can be temporarily affected by negative market news that causes its stock price to plunge, we also know it's very likely to recover over the long term. And in the same way that bad news can cause a company's stock price to drop, good news can have the opposite effect and cause its price to surge during this recovery period. When a company publicly announces how well they did financially for the previous quarter, that makes investors feel excited, and they want to invest their money in that company. And when the demand increases, the stock price simply goes up. In either case, whether a business simply recovers its true value in time because of its intrinsic value, or becomes suddenly overvalued as the result of some positive event like share buyback, it will be the time to sell your stock and take your profit in the spirit of buying low and selling high. So I want to pay close attention to these events because they can help the stock price go up very quickly. And you'll also have to be quick to sell your stock and take the profit. Share buybacks and stock splits are common events that can lead to an increase in a company's stock price. Share buyback is a program by which a company buys back its own shares from the marketplace, usually because management thinks the shares are undervalued. And stock split happens when a company divides its existing shares into multiple shares to boost the liquidity of the shares. So as a value investor, we can take advantage of these golden opportunities to sell our stock at a temporarily high price and make a higher profit. And the stock price tends to go up during a bull market or economic upturns. And events like mergers and acquisitions can also lead to a significant movement in stocks. A merger is when two companies merge together. An acquisition is when one company buys out another company. So you need to pay attention to these events, especially the earnings announcement, because it happens almost every quarter, so we'll have at least 4 times a year to make big profits. In the next lecture, we'll talk about price and value, which is a very important topic in value investing. Okay, see you in the next video.